early exchange, shaping policy, advancing development.
Getting straight into the conversation for this morning, we have with us, joining us virtually, our finance analyst and the CEO of Finance with Muktar, Muktar Mohammed, as we look into the warning of the Bank for International Settlement to banks globally about being complacent, thinking that the recovery from the COVID-19 era is over and then financial system is stable. But the head of the Bank for International Settlement has warned that the banks should not be complacent. What does that mean? What could banks, central banks across the globe do that could result in some form of instability in the financial system? Let's find out from Muktar Mohammed. Good morning. Thank you for joining us as always.
Thank you always for having me. Good morning.
A delight to always host you because we know that you provide insight on the conversation. Now, looking at the global financial system after the COVID-19 era, and now that we're having some form of geopolitical tensions across the globe, but the Bank for International Settlement says that the global financial system has showed some strength. Regardless, the head of the BIS warns about complacency. What do you make of this warning? Is it needed at this time? Are there threats that could become some headwinds for the global financial system?
Thank you. And I think there's a lot of threats that could come in the space. Maybe going back to do business the way you want to do. You're not looking at that sudden issues that might happen, especially with global finance things that they have no control about. This also could be as a result of maybe you're giving loan to customers or businesses without looking at the risk level of it. Oh, sometimes we tend to forget history and we don't know that history sometimes repeats itself, but in a different time or different season. So I think they are warning the banks so that the banks should not think it's all over. We go back at business as usual. There could be any event that. So what it's saying to the bank is to build up your risk level, look at how you can tame inflation, look at how you can create growth within your economy because what the global financial crisis have told, I mean, what the COVID-19 pandemic have taught everybody is that at a point, everybody will have to deal with his own situation by its own self in his own way. I think that for me is what they are trying to make most of these banks know. So you don't just think that you can depend solely on other countries or other banks to sort out your issue. You must begin to build a framework and make sure that you have a very strong risk management team so that you don't have a systematic crisis, especially in the financial sector.
Okay, if I had to weigh in on this, glad to connect with you, Mukhtar. I would want you to shed some light on what the BIS is and what its role, in the financial market is. I don't know if you might oblige me with that.
I didn't get to your question. Please can you come again?
So I was asking if you could throw some light, if you could explain the role of the BIS, also give us a background of what the BIS is, and then, we could actually take it from there.
Well, the BIS is just like a pressure group. It's not really, it's more or less like a global pressure group that tend to look into financial independence of major CBN. These are groups, you have major pressure group, you have the rating agency, you have also global rating agency, sometimes having just the rating agency. They are just a pressure group that try to look at the finances of bank and they are independent. So they are not a group that is closely controlled by any government or any institution per se. So, but I think what they do is to make sure that they look at this independently about what is happening around those economic of the world. So the more it's just they are just a pressure group that tend to look at things, maybe let the bank know, you know what, you need to be careful in this area, you need to be careful in this area. It's different from a global rating agency that will tell you, oh, you are negative, you are this, you are negative, but their own specifically is to look at the challenges that are coming, advise on how they think that banks should manage these challenges.
All right.
So the BIS, which is the Bank for International Settlement, has raised concern about the act of balance between having monetary policies to control inflation and also having economic growth. Now, what can you say about what different countries have done to arrive at where we are now, where there is some form of growth and balance? But is it widespread? Can you say that the growth so far or the strength that the global markets is having now is widespread?
No, it's not widespread. You see that developed economics have brought inflation to about single digits, from a height of almost double digit 10 to 11%. They brought it down. But when you look at developing economies, you realize that they are still grumbling with high inflation, they are still grumbling with debt servicing, they are still grumbling with trying to maintain growth via exchange rate volatility, especially in developed countries. So definitely, that they've not been that seamless growth within all the board, and I think that's why they are also worried about that, because it seems to be that they've growth one side and another. And when you look at growth, especially because to tame inflation and to maintain growth, every economy has its own peculiar challenges. If you look at the developed economy, most of what had brought them to where they are has to do with supply chain distortion, which they're able to manage either through the intervention through proper data system, maybe the intervention by data trying to give households directing with cash interventions, which were managed globally, and then look at how to improve supply chain. Some of them have to go into their reserve in the area of energy, especially oil and gas, to get into the system to stabilize rates. But when you look at the developing economy, most of them have not been able to do that, because that also will have an effect on their revenue. And again, so that's why you see for them to do that, then they have to do a lot of debt. So, and you see that the developing economy, despite all these challenges, are involved in a lot of debt profile. They are trying to address up to this moment. They are rising debt from this income. So the growth have not been seamless, because every situation is different from the other situation. In terms of growth, you see that CBNs are fighting. The central banks of the majority developing economy are struggling to maintain a balance between growth and taming inflation. And that is due also sometimes because of the exchange rate volatility that they have in their economy. So they're looking at ways. So some of them come up with strategy to attract foreign investors, and that to stabilize their rates, and that also have a negative impact on indigenous businesses, because that means some of them have to hike rates. And they look at hike of rate to tame down inflation. But some of them, again, their economy is largely an informal driven economy that is largely driven by cash supply. So they are all in a dilemma to either you grow the economy, or you maintain a stable exchange rate, then think of taming inflation. So it's not balanced, because like I said, every economy has its own peculiarity.
Okay, so Muktar, what would you say are the main factors that has contributed to the current sense of complacency which we are experiencing in the financial systems and the financial markets right now?
So I think regulatory framework was very weak. Like I said, most of them were not prepared for the kind of issues that comes in, especially the COVID-19 situation. There was recklessly in terms of loan, especially in developing economy and also some developed economy. I think basically most of them were not prepared for what eventually came on them. So that for me is what has really been the challenge. And also that is due to regulators not putting their feet down to a proper regulatory framework, because they allow a lot of issues to be swept under the carpet, and not knowing that those issues tend to affect them going forward. I think basically that is what. Then secondly, again, I think they had no control over events that happens in the world. You don't have control over the COVID-19, and after that, you thought you were trying to settle out of the COVID-19. Then came the other situation of the Russia-Ukraine crisis. All these are supply distortion processes that they had no control over. But again, people will always say that you know that there will always be a black swan event that may happen along the line. So banks and their regulators need to build a strong risk management framework. And if you have a strong risk management framework, then you begin to look at ways to guide against sudden events that you have no control over.
All right, so let's get back to what you said about the growth being different in many countries because they have peculiar situations. Now, bringing it to Africa, where there's a peculiar situation of higher debt level, and the BIS has warned that central banks and banks across the globe should not be complacent. And it suggests that aggressive monetary policies could see a return to higher borrowing costs. It could make the global markets volatile. Can you shed light on some aggressive monetary policies that have been made and that countries could make the mistake of making, and how it could impact African countries, African economy, being that their own situation is peculiar?
Yes, one of the challenge of African economics has been that we depend so much on the foreign economy, foreign partners, and with African economies don't do business within themselves. You cannot talk even in terms of business traveling, um, visas to even go to do business in other African countries. Sometimes even easy to do business in European nations than in African countries. So that itself is a challenge because we are not doing business within ourselves. We're always caught in this crisis of currency devaluation, currency issues, and the major trading currency of the African nations still remains dollars. You have, and we are not actually in control of those space. So that for me is the major concern for African economy, and that's why you see a lot of them who go cap in hand trying to beg for loan or grant from or maybe all world World Bank or IMF or some financial institution like International Finance Corporation. And so that is a big challenge for African economy because what you see is that the central bank is dealing with multiple issues. If you ask the normal developing central bank governors what they are dealing with price stability and inflation and managing inflationary pressure. But when you ask the central bank in Africa what they are dealing with high debt profile, they are dealing with exchange rate volatility, they are dealing with high cost of production, they're dealing with cost of demand of supply also. So these are peculiar to African countries, and sometimes that's what now because the high cost of borrowing in their economy, because most indigenous African economy tend to borrow want to borrow from their own financial sector. And because the regulator, the CBN, is trying to control inflationary pressure and try to do what you think is done in the developed economy, high rate, without looking at the precarity of the environment, then they start to kill indigenous business to the good of foreign business that come in to get the hot money and then go back. So and again, when you look at African countries also trying to look for funding, they tend to go to do Eurobond, and the kind of rates they are giving them is very high. And so that will now involve rescheduling of payment of its euro bonds, rescheduling of payment of its debt, especially like what you saw in Ghana also. So the African countries are just in between that because of the peculiarity that they have to deal with compared to the developing economy that have a single or a double issue that they are dealing with compared to African economy that have so many issues that they are dealing with. So for them to be able to handle some of these issues when they begin to do business within themselves. And that's why you have the African Continental Trade Agreement. But fortunately, that has not seen the light of day like most African countries have thought. So it's a big challenge. And the debt profile keep rising because they are looking for ways to be able to meet up local demands of their product, or trying to meet up local demand in terms of pressure of high interest rate. But most African economies have really suffered from the devaluation of their currency, and then trying to attract effects into this economy then tends to also affect local companies there, and then cost of living has gone up, and then the earnings of most of them also still remain the same. So it's a big challenge.
Well, Mukta, you have done great in shedding some insight here for us today. But then I'd like to take it a notch higher. Um, I'm wondering what your thoughts are on what sectors of the Nigerian economy you think are mostly at risk as a result of the financial instability, which, of course, BIS is warning about.
For the Nigerian economy, I think the manufacturing sector is highly risked, and you can see that with the FX losses from some of these manufacturing sector and service sector that are FX dependent. You could see that in the telecommunication sector with the losses you see companies like MTN does. You could see that in the manufacturing sector if you look at some of those companies listed in the exchange like Nigerian Brewery, Guinness Nigerian PLC, and also Unilever, also you see that in PZ also. So major challenge for Nigerian economy is majorly the manufacturing sector, because these are not sectors that have high savings in terms of effect, because they are driven locally. So they never thought issues like this will come up. And then because of those challenges now come the cost of funding is also high, because the central bank is trying to battle inflation and also trying to maintain currency stability. And so that has created high cost of funding for them. So the cost of borrowing has gone up to them. And if they want to maybe said, okay, you want to attract cheap borrowing by coming to the stock exchange, the earning ability of the average Nigeria or the retail investors have gone down. So most of them will not be able to participate. And so that means you are opening yourself back to foreign investors that are here for the hot money. So the major areas that have really been affected by this is the manufacturing sector in Nigeria. And that, unfortunately, the manufacturing sector also have two key that there's the formal manufacturing sector and the informal manufacturing sector. And now the formal manufacturing sector are the sectors that, like I said, the Unilevers of this world, they try to access funding through banks that comes with high cost. The informal sectors are the sectors that are largely driven by cash. The woman, the petty trader, the market women, the SMEs, and then to control inflation in this state, that CBN is mopping up liquidity. So it's stifling those businesses. Those businesses cannot grow. Sometimes people look at the turnover for these businesses. The turnovers are good because of the exchange rate hike that you see. So you tend to be more turnover. But again, this turnover are swallowed by high cost of production, exchange rate volatility. So when you look at the bottom line is hugely very, very poor. So those are for Nigerian, I think the manufacturing sector and some of the service sectors, like I said, the telecom sectors, was hit by these policies.
Looking at the banking sector itself, what's the fate of the banking sector, even as the BIS has warned that banks should have strong reserves? And you recall that the central bank had been advocating for consolidation of the banks in Nigeria.
Well, for the bank in Nigeria, it's a big challenge because, again, in the news, we've seen how the central bank itself is coming hard on them for the sharing of 50% of their capital gain and FX. And so that is going to be a big challenge. And they are thinking of consolidation. And most of the recapitalization the banks are looking for is for expansion in other emerging markets, especially in Africa. And some of these FX are meant to grow, to acquire some banks or establish some banks in this emerging African economy. And so they are really, really in a very difficult situation with those policies that came out through the amendment of the Financial Act by the government through the National Assembly. So they have those challenges that they are battling with in those space. So definitely that is not helping them in terms of trying to grow the economy or trying to be like a pace setter in the $1 trillion economy. So it's going to weaken them in terms of the area of expansion because of most of those challenges that they are encountering in those spaces. So I think Nigerian banks are really, really in a very tough situation. Remember that the global best practices is, if you say you want us to increase our capital base, it's for us to go to our retail earnings and make sure that we grow our retained earnings. From the retained earnings, we can now use it as shareholders' fund. But unfortunately, the CBN is saying, no, you don't have to use your retained earnings. So you need to sort for fresh funding. And then the fresh funding depends on the bank. So it's really, really very, very tough for the Nigerian bank, especially with this 50% capital gain, that FX factor gain that the government is saying that they need to give to them to fund their recurrent expenditure, the supplementary budget. And again, that comes with some legal implication, because this FX capitals or gains were actually taxed by 30% from the personal income tax. So are you saying that they will need to pay another 20%, or you're saying you want to collect 50% from them? So that means you're taxing their efforts by almost 70%. So it's a very difficult situation. You put your financial sector, and that could create a systematic challenge, which will involve into legal issues, legal issues between the government and the banks, and that is not good for foreign investment. Policy seems to be depending on your needs to meet up your need in terms of fundings in some projects. So that doesn't augur well for the Nigerian economy, and that's not good for the banking space.
Mukta, is no hidden fact that most families right now have a very low purchasing power. But then, if the warnings by the BIS is not heeded, how would you say it might affect small businesses and households in Nigeria? We've talked about the manufacturing sector, we've talked about the banks, but then if we had to narrow it down to the person on the last rung, which is the households or the small businesses, how do you think it might affect? Is it going to have any form of impact on them eventually, yea or nay?
It's already falling down on them, because small businesses are struggling. Like I said, CBN policy also in the area of starving them of liquidity also have not helped them to grow. So definitely those businesses are really, really struggling already. And the household, like you said, are struggling. Even just yesterday, the president signed the national minimum wage from 30,000 to about 70,000, which ordinary usage would have been an improvement. But when you look at it as per July, uh, May 2020, May 2023, when this government came into power, the minimum wage was 30,000 naira, and then when you look at the exchange rate at that time was $600, $600. So by the time you 20, that was about $43. And if you go back to yesterday, about the minimum wage was raised to about 70,000. And when you look at the exchange rate, I heard your reporter says about 1,600, but let's just park it at 1,500. The minimum wage still comes down to $43. So that means households are still where they are with high inflation to cope with. And when you have high inflation, sometimes the challenge is that people are not, the earning ability is not there. So most businesses don't have customers that patronize them. So and then so they tend to go out of service, because again, the household that used to buy 2 items will now decide to buy just 1 item. So it's a very, very peculiar situation Nigerians are. And the government itself seems not to be thinking out of the box, because other developing economies that have situations like this, and what the government do is to look at how to take a bite of their revenue, suspend tariff on many household import depending products that many households depend on, and then also by that driving down cost of those of those goods, so that the ordinary people can be able to have a breather. But as it stands, I think the government is looking for revenue everywhere, so they don't think to want to take a bite of their revenue, even if they've said, "Oh, we are going to have a suspension for 150 days." But when you look at the goods they have in suspension in, yeah, you have rice, you have other products. I mean, rice, you have stable food, but you are not looking at other proteinous food, which are what our children need to guide against malnutrition. Those are still coming up with high tariff. And most households in Nigeria, those are what they are dealing with. So high cost of energy also has gone up, because you are seeing the Nigerian Bureau of Statistics have told us that the average cost of petroleum product was about 720 naira. And then you look at that bar and bar, the cost of power, which has gone up by almost 200% with those that are in band A, and most of these SMEs and small business are working around band A. So it's a very, very peculiar situation that those businesses find themselves. But the only way that these businesses can survive is when the fiscal and monetary policy comes up with decisions, especially the fiscal side, that will help businesses grow, while the monetary, they try to manage whatever situation that the monetary side is throwing at them.
Now, having warned banks not to be complacent and advocating for more aggressive monetary policy, but let's come to Nigeria. If we're looking at measures to explore to increase the strength of the financial system, perhaps one of them would be effective policies by the central bank that would encourage responsible lending and, of course, would create the environment for the businesses around to thrive. But when we talk about aggressive monetary policy, it seems like Nigeria is ahead in that line. There will be another MPC meeting, which is the Monetary Policy Committee meeting of the central bank. 3 so far have been held in the year, and we've seen that the interest rate has been increased. MPR have been increased. Now, for this one that will be happening soon, what's your expectation? What's your recommendation?
Well, if you ask me, since the NPR have been hiked, or has it have any impact in bringing down inflation? The last thing we have was that inflation has gone up to about almost 40%. So when you look at it, right, I normally say that what we have been doing is copy and paste. We are trying to hike rate. Like I say, we are not looking at the precarity of our own. We are trying to stabilize FX rate. So we are giving high returns to foreign portfolio investors who are here for the short term. So that has not really addressed our problem, because we are not dealing with the core fundamental issue that is driving our volatility in terms of what's causing inflation in our own economy. And in our own case, it's exchange rate. So I keep saying the only way the CBN can address this issue is to make sure you have enough of liquidity and stabilize the exchange rate. A situation whereby I bring in a good at 1,600, the next time I'm bringing in a good is 1,500, the next time I'm bringing in a good 1,550. It does not attract investors. It doesn't even create investors that want to invest in your economy. No matter the name you call it, market determining rate or whatever you call it, doesn't add up, because that means your rate is not stable. No investor want to invest in an unstable forex rate. So if you tell me as a CBN you've done what you've been doing for past years, remember this issue of hiking rate did not even start with this current CBN government. That started with the former Emefiele government. They kept hiking the rate. We started this journey with the United States, with the UK in terms of rate hike. They have hiked rate. They have settled down. They have looked at the internal problem. Today, their inflationary pressure has come to a single digit of 41%. I mean, between 3 to 4%. And here we are. Rather than coming down, ours have been going up, and we are now at, when we started this rate hike, inflation was 18%, and today is almost 40%. So you think it has doubled. So why will we keep doing same thing and all over and thinking that we'll have a different result is what I don't understand. So for me, I think the major problem with the Nigeria economy as it stands now is the exchange rate volatility, caused with the having the cost of living, which is very, very high, because again, energy, like I said, energy costs have gone up, cost of transportation has gone up, cost of power has gone up. All these are pricing. So we are dealing with a monster inflationary pressure, not just inflationary pressure that is driven by supply destruction. We are dealing with an inflationary pressure that is driven by cost of production. We are dealing with an inflationary pressure that is caused by demand and supply pressure. We are dealing with an inflationary pressure also that is caused by microeconomic policy and fiscal policies. And also we are dealing with an inflationary pressure that is caused by exchange rate volatility. So it's a peculiar situation. So, but to address most of these costs is to stabilize the exchange rate, because if you look at cost of production, has all to do with high energy costs. And why is we're having high energy costs? You say because of you are still importing refined petroleum product, and the cost in terms of dollar exchange rate is high. When you look at cost of production, it's still the same thing. You look at the power companies, what are they raising for the hike in power tariff is because they say the exchange rate is high. So when you look at all these things come together, I mean, you just know that your problem is you think you hike rate. No, why hiking rate as it is now is killing little smaller businesses because the cost of funding is going high. And that's why you see even multinational cannot sustain their businesses they are leaving the country. So if you ask me, I think that what the CBN have to deal with is exchange rate. And now they are trying to look at the invisible side, which is the retail sector. I mean, that's why they are saying, okay, BDCs begin to have $20,000 weekly, or they've not even told us whether it's weekly or monthly. They've came up with this strategy before, and that helped drive down the exchange rate. But they suspended it and then decided to revoke licenses of bureau de change. So what you see in Nigeria now is inconsistency in terms of government policies. Yeah, I normally say that they go into the panic mode. Now, the panic mode is coming again because exchange rate has now high almost 81,600. And so the government is now running back. Oh, bureau de change. It's time for us to begin to give you FX again, so that you will see I will give you FX at 1,400. So the challenge for Nigerian economy is not rates hike, is stabilizing the interest rate, because over 70 to 80% of what we consume in this country is imported. So take a bite of your revenue in tariff, stabilize exchange rate, you would drastically address the inflationary pressure. So you're telling me CBN meeting the multi-policy committee next week? I think they have hiked the rate so long, they have not seen any results. They should channel most of their energy in trying to see how they can get more liquidity into the system and maintain stability and leave rate as it is now, because even with this rate hike now, businesses are really, really suffering.
I think two words that have featured prominently in this conversation is stability and instability. And in the light of these, how would you say that participants, market participants, policymakers can actually monitor and gauge the health of the financial system? Because you talked about investors not wanting to put their money in, in the financial system when you're not certain of the outcome or your profit. So how then can you monitor and gauge the health of the financial system? So per time, you know what to do as regards the issue of stability and then instability.
There are two ways to monitor your financial system. That's easy in economic terms. You look at foreign direct investment or foreign portfolio investment, you put them at one. Then, secondly, you look at what is happening in your stock exchange. So most of your policies, you tend to see the result in your stock exchange, and then you have to go back to the drawing board. Now, let me give you an example. The recent policy of the CBN to take 50% of the capital gain in terms of FS gain from the banks. You saw what happened in the market yesterday. The market was red. All the financial instruments were red. So that tells you that that's policy is not friendly. It's not investment friendly. And then you are in an economy, you are trying to attract more investors into your economy to stabilize your rate. Then you look at foreign direct investors. They are not coming in because you don't have stability in your rate. So what do you do to stabilize your rate? You look at oil production. That's a major way of FX. Then you look at Nigeria and the diaspora remittance. How do you attract more of those remittance? Do you just wait for those remittance to come through the international money agent, or you create a product that they will invest in for long term and then be able to earn a lot of remittance into the system, or you depend on the foreign portfolio investors who are here for the short term. So those are the barometer you use to gauge whether policies are moving in the right direction or not. And so, but when you look at most of our policymakers, I think they tend to say, look, this is the policy we want to do. Whether the gains comes in or not, they tend to be rigid, telling us to looking at the future, that they are thinking the result will come in the future. But in the short term, we'll have to battle a lot of challenge, which is, yes, that's what normally happens. But there must be a little bit of light to even see the future where you are going to. Well, when you start with a lot of policies that more or less stifle businesses, cause inflation, drive and bring down the earning capability of your people, how are you going to address that in the future? That makes your people to lose hope in your economy, and also foreign investors are not wanting to come to your economy because they think there's no stability. So the major way you need to look at those barometers is to look at the response from investors, both local and foreign, and then you begin to step yourself, and then you just come up with policy. Sometimes you need to engage the stakeholders. You need to engage the stakeholder, the big player in that sector or the small player in that sector, to know what their issues are. And then you say, okay, this is the policy that we are coming in. What are we going to do that will help your business grow, or what is, because you look at the Nigerian informal sector, it's the largest employer of labor. And so when that sector is being killed daily, that means you are sending a lot of Nigeria more into the unemployed market. That's why you need to engage them before you come up with policies.
So one thing that is been known about so many countries now is the high debt level, particularly African countries. And the high debt level is not particular to the government sector alone. Even corporate entities are also having this challenge. The BIS is it also ensures cooperation among international central banks. So what kind of support can the BIS rally on behalf of countries that are having high debt levels, distressed by debt, to ensure that they are not more vulnerable to economic shocks?
Debt forgiveness, debt reshuffling. That's just the two answers. There's no way. If you want them to be, you give them debt forgiveness or you give them debt restructuring. Those are because basically they are battling, like you say, debt issues. So what do? You give them debt forgiveness or debt restructuring. It's as simple as that. So those are what I think they should be looking at, because by the time you give them debt forgiveness and debt restructuring, then they will have a breather to begin to look at how to deal with their internal issues. Because most of these debts that they are battling with comes with conditions that are not favorable to their economy. You want to give them some debt. You say, okay, you have to hike taxes in this area. You have to increase power tariff and all. So because they are so indebted and they need, because those are what your policy is tied to them and they need it, then they tend to implement it, and they stifle their businesses and create more problem for their people. So, but when you give them a breather of debt reshuffling and debt forgiveness, then they are able to look at things critically and come up with homegrown solution to their problem.
One more question for me before I throw in the towel, and that is, I would want to know the role of technological advancement in all of this. If you think that, technological advancement will help in shaping the future of monetary policies.
Definitely, definitely. That's why you see some of the Nigerian banks even have said they are now growing fintech companies, and the fintech companies are technology-driven companies. So that's why you see most of them are now coming into holding companies, because that's the next way everybody is going to technology, artificial intelligence, and but those also help reduce pressure on liquidity in the system, because some of this liquidity will find their way through technology space that seems to have control. You know what measures that you have put in place and what amount of liquidity is it, and how much you can control this liquidity. So you can't do that. And then again, financial inclusion, because especially in countries like in Africa and Nigeria, whereby financial inclusion is a big challenge. So technology needs to be one of the key drivers of financial institution. Yes, you try using the POS terminal. Those are the type of what we call analog financial inclusion. If you look at Kenya, they use Safaricom to make sure that they connect every rural area. That has been a game changer in terms of financial inclusion. So for them to do that, they build a robust joint infrastructure that has to deal with technology in terms of this financial space. And that is one area that I thought the CBN would come, instead of trying to tell us to pay for cyber security and other things. I thought they would come up with synergy whereby all banks will come and manage a particular infrastructure, either through a consultant or through a third party, manage that infrastructure to be able to reach locals area, and especially the technology companies, so that we can be able to do seamless transaction in the comfort of our home. And that will help bring more people into the financial space. And that also will increase revenue of government, especially taxing. So you are able to know who is to be taxed and what amount to be taxed. So you cannot progress in this century without looking at the advance of technology, especially now that we are going to the advance of artificial intelligence. But in this part of the world, we always come to the party lead.
Now, in a bid not to come to the party late, countries such as Canada, Australia, Singapore, Denmark, Netherlands have been considered to have stable financial systems. What's unique about them? What's common to them that can be copied by African countries so they're not late party attenders?
Regulators doing their work, risk management is priority to regulators, and also looking at ingrown house policy to grow businesses. Not looking at the normal global textbook economic policies, looking at your economy as it is in-house, looking at the practicality of your economy, coming up with in-house solutions that will create jobs, that will put food on the table of the average citizen, and also create a level playing field for other global players to come into your economy. And those are what they have done. And I think that is what most developing economies, especially Africa, should begin to look at. The era of copy and paste is over. They should begin to look at the practicality of their own economy and begin to come up with homegrown solutions to some of these problems, like those countries that you have mentioned.
So much, Muktar Mohammed, financial analyst and CEO, Finance with Muktar, for your time with us in L Exchange today.
Thank you for having me.
Early exchange, shaping policy, advancing development.